Reset. Okay. Okay. So, without any fluff, just straight to the facts. The man that you see sitting right here, that is no longer muted, his name is Patrick Boyle. He's an actual hedge fund founder and a very accomplished one. He's not one of the bad guys before you go and judge him as a hedge fund founder and the CEO and all that stuff. Patrick actually runs a very known hedge fund by the name of Palomar. It's all about quant futures trading. It has nothing to do with what's going on with shorting and none of that stuff. It's a whole different scheme of things. But he's also a professor at King's College in London, and an actual author. And he's much more accomplished than me to talk about the subject. So I'm sorry I had to put you through this, Patrick. Respectable member
No
of the finance
problem.
community. But I'll just, before I let you introduce yourself, I'm just gonna let you guys know. Don't have any prejudice about this because trust me, Patrick is one of the most honest, transparent, and realistic people you're gonna see talk about this, and he's very qualified. And also, trust me, he's on your side. So hear this man out.
Yeah, well, I guess I was explaining that I teach at a university, and over the last little while, this story's been developing, and it's been covered rather well in the media. But a lot of my students were saying, explain this, explain this. So I put up a video a few days ago explaining it. And I guess to a certain extent, some of the story is maybe a little bit more technical than a lot of people think. And there's all sorts of questions around things like the legality or illegality of what's going on. And, mostly I just find this interesting because I trade futures. I don't really trade single stocks. So I kind of more approach them. I kind of have maybe more of an academic interest in them than a strong interest. And I largely find this whole GameStop thing to be amusing. Like it's quite an entertaining story.
So Patrick, as one of the guys who actually manages a hedge fund, can you talk to us about? My first question to you and I've seen a bunch of your videos. By the way, if you're not subscribed to Patrick's channel, Patrick Boyle, just look it up. It's a must. It's criminally undersubscribed with 70,000 subscribers. It deserves way more. So, can you tell us about the halts? Nasdaq has been holding trading all day long yesterday, and we've never seen this done when the share goes up. I mean, at least not that often. I mean, can you tell us a lot of conspiracy theory, a lot of misinformation? Can you tell us the actual factuals without all the BS?
This is just something that happens to a certain extent in really volatile markets. And there's a bunch of reasons that exchanges halt trading or even stop it. It's often like in this situation, it's most likely like I just have experience. I don't have a direct word on this, but often when you're trading in very volatile markets, you'll see this happen. In things like the futures market, it's very defined as to when it will happen. In stocks, sometimes even we'll say, for example, if there's what they call a fat finger mistake that will happen in the stock market where someone accidentally, they want to buy $1 million worth of something and they buy 1 million shares instead. The market goes insane and the exchange sort of step in to try and normalize it. And that's most likely what we're seeing. We're also seeing like the brokers are seeing sort of huge flows. Like if you look at the trading volume on these stocks, it's way beyond what you would expect in stocks like these. And so that flow hitting the exchange, at certain times, like if you have a live price feed and you look at it, you almost can't say what the price is because whatever price you think it's at, by the time your mouse has clicked, it'll be at a different price, And so to a certain extent, I don't think there's anything horrible going on there. I think that the exchanges are really just sort of struggling to deal with some of this volume. In addition, there's even, there's a lot of people talking about what's going on, like the brokers yesterday, a lot of the sort of small brokers stopped allowing people to buy. And obviously that looks very bad. And it's not great service from a broker, but they're not sort of full professional grade brokers, if you know what I mean. Like, not to beat up on some of the kind of trading apps, but they're sort of, people look at them and they think it's sort of a motorbike and instead it's kind of a kid's tricycle with little wheels
A
on the
moped.
side,
A
you know.
moped.
And yeah, I mean, some of the issues with some of these discount brokers is that essentially what has to happen, like when stock is bought and sold, we all think that you hit a button and you buy and that you now own the stock and that it's instant. And in this digital age, in truth, you should expect it to be, but it's not. There's sort of a 2-day settlement issue, right? So when there's always credit being extended when stock is being bought and sold because it's settled 2 days later. And so normally that's not a big issue, but when something gets really volatile, like a stock like GameStop, for example, what happens is that, when it's at a point where, we'll say in 2 days' time when these trades settle, you wouldn't necessarily be surprised to see it at $1,000 or at $10. Like either is entirely within the range of possibility, when something that is this volatile. And so essentially the clearinghouse that does this trade settlement has to worry about both the brokers and the customers being able to settle this. And when you have some of these brokers, they're allowing their customers to trade on leverage, either in margin accounts or with various derivatives, or even that they're just sort of undercapitalized accounts in general. There's a concern that either the broker or the customer will blow up and that the trade won't settle. And so some of those brokers had to actually essentially de-risk until they put up more capital. And I believe Robinhood raised a bit more capital yesterday, and now people are able to trade in there again.
But Patrick, here's the thing. So, why are we? Of course, you don't have direct knowledge, but why would the brokerages would not margin call Melvin on these shorts?
Oh God, I'm sorry, but there are people. I mean, you've got to imagine at a firm like that, there are people who haven't slept in a week, right? Like, I mean, the brokerages will be all over them, because when a big institutional investor like that goes bust, which is, within the range of possibility as well. The last big example we have, well, there's been a few, but a good example of that was long-term capital management back in '98. The Russians were to blame. And no, it was over leverage was to blame, but still, when that melted down, it caused all sorts of problems. Like the US dollar almost had to be devalued. There was, the banks all, the Federal Reserve had to call the banks together and arrange, some sort of a thing. JP Morgan fell like 80% in a day, the stock price, because of long-term capital management. The brokers are investment banks that will provide prime brokerage to a firm like this are very aware, and that's actually their fear. They're not really that afraid of the Robinhood guys going bust. They're very afraid of these guys going bust. And so they will, it's really hard to know what's happening, but I believe they got some additional capital in from 2 other hedge funds that kind of were sort of helping them to sustain their position. But the truth is they'll be in a situation where they get a phone call. In fact, they probably get a phone call an hour from their prime broker telling them either that they need more capital or they need to sell more shares. And they will be doing that, because you don't get to, you can't walk away from that. And the broker could go bankrupt. Now, I don't know who they prime broker through, but whoever they prime broker through will not want to be left with any wreckage. And so it's not even the position in GameStop, but they're possibly unwinding a whole bunch of other positions as well in order to basically get their equity up so that they can either stay in business or even just unwind in a sort of a manner that doesn't cause big problems in the market.
So Patrick, tell me if you agree, based on your point right now. So 3 days ago or 2 days ago, I haven't slept in a few days. So a few days ago, I made a video and I said that what I expect to happen is that, well, exactly what you said, is the brokerages forcing Melvin and all the other people who shorted to liquidate the good horses that they have and sell all the long positions so they can actually cover the shorts. And then I told my subscribers we probably will see a dip towards Fridays on all the good stock. And looking at numbers right now, everything is red. All the good stock are red. Tesla is red. Everything is red. So do you think it has any connection? Do you think we might be seeing it now?
You might be seeing that. Like when there's a few things that happen, because just whenever there's stress in the markets, things unwind, because across all of these financial institutions, like even, I worked at a big bank during the credit crunch. And what happens is that when things it's not even that there's a specific meltdown, but just when things get volatile, most of these firms, they have value at risk requirements. They have a requirement to sort of keep within certain risk management boundaries. And so what really happens is, we'll say if the market just even gets volatile, that just means you've got then a wider standard deviation, and you'll be told that your positions have to be within a certain risk in terms of standard deviation. And so positions generally get unwound. And you see that a lot when there's either sort of a lot of trouble in the markets, at these firms, they have to unwind positions. A good example was, how long ago was it? It was in around 2007. There was what was called the quant quake, when a big, I think it was a Goldman Sachs quant fund kind of went on the ropes. And basically, a lot of firms will have similar positions, and it's not necessarily even the position that's in trouble that gets unwound, because what happens is that the position that's in trouble is often almost impossible to unwind, because you're trying to sell and there's a vacuum there, and so you'll positions being unwound, you might see quant positions being unwound, all sorts of different strategies getting unwound, really just to have good capital ratios so that your prime broker doesn't shut you down, because basically the way it works is you're given you get a call, a margin call, and they basically say you need to wire in this much money today, like before close of business. If you don't do that, we're going to sell your position right now
at the market price.
And you have to imagine that they won't sell your position with any delicacy. They don't care what you get out of it, right? So they will throw that at the market like a rock. So you are either going to come up with capital, or you're going to try and unwind your position as delicately as you can.
So they're going to be obviously there's a cascade effect here. So Melvin is
risk sort of spreads through markets. Now, it shouldn't be a nightmare, but because this isn't that wild an event, because it's quite concentrated, I believe, but it does reach across to other areas.
Patrick, I have to ask you a question. It's going to be a little bit uncomfortable, but I trust you'll give me an honest answer. Who are the bad guys in the story? Who are the good guys in the story? Be honest.
You see, this is the thing that I think you and I slightly disagree on, is that I essentially don't see good guys or bad guys in here. I just see it as a trade. And essentially, the hedge fund guys are kind of used to winning just because, that's how they got that big, right? Like, you don't build a multi-billion-dollar fund without having a strong track record of winning a lot. Someone else has now found a trick. They found a chink in the armor, and that is going horribly badly at Melvin Capital, and it's going quite well if you're a trader who got long GameStop. It's also probably not all retail investors. We'll get back to that in a moment, but essentially, this is all just positioning. Like, it's sort of a poker game, and you can see there's one guy at the table sweating bullets, and everyone else is sort of moving in on him, and that's kind of what's happening. And there's no, there's people who want to say one of these groups is good and one is bad. They're all kind of just trying to win, and that's all that's going on. There's no there's a lot of people. I feel a lot of misinformation out there about the idea of short positions and is shorting stock evil. It's just not. And even there's a lot of people that are confused about whether there's an awful lot of what they call naked shorting
Well, that's a
going
good
on, which
point. Yes, let's talk about it.
yeah,
So that's a
well,
great point.
so
Can I ask you a
naked
question?
shorting,
A layman
yeah,
question. Okay, so since I'm not
yeah.
a short, okay, so you're the professional here. So I always, okay, Nick, just, you know what? I'll let you, why am I speaking? Okay, but before you do it, can you please explain just for the audience exactly what naked shorting is? And then
Okay.
let me have you, I
So,
mean, you
so
speaking is much more useful than me.
well, naked shorting, firstly, is just illegal. And it's when you sell stock that you don't have. You can't do that. And the reason you can't do that, firstly, it could be used as kind of an aggressive tactic to sort of push down the stock price. Now, I don't really, the problem with these things is that often, like if you do something, if you did a trade that pushes down the stock price, then you always have to buy it back, which will push up the stock price. So it causes a disruption, but it's not really a disruption that should largely bother most investors who are long-term investors. But it is wrong and it is illegal. You usually can't do that, and especially I wouldn't think a hedge fund could do this. But what they do is they help you borrow stock. So what happens is that you borrow stock from someone else, someone who owns it, and then you sell that, right? Because when you sell it, someone's bought it from you and they have to receive it. So you can't sell something that you don't own. So you borrow it, sell it, and you have to give it back to the person you borrowed it from. Now, not only that, but that person doesn't lend you stock for free. They charge you. And at the moment, I don't know what it is right now on GameStop, but last time I looked, it was about 30% borrow rate. So it's very expensive to borrow, right? So you have to pay 30% a year to borrow that stock, which means that if you borrowed it, shorted it, and the price fell by 30%, you're just breaking even if it took a year for that to happen, right? So there's a cost. And so when people say like, gosh, it's an awful thing, if you own stocks, you're usually doing all right out of stock borrow. Because we'll say, for example, if you invest in an index fund, like a Vanguard fund or something like that, a lot of the reason that the fees are so low on those funds is because firms like Vanguard and Fidelity and all the big funds, they have a lot of stock and they have it in a very stable manner, like it's not being bought and sold constantly. And they're able to lend that out. And those fees then go to their customers, So that's how shorting works. Now, the thing that's confusing a lot of people, and it actually is very confusing, is when you see the short interest above 100%. And you might say, well, how can this happen? Like, how can
it has to be naked
you can't have borrowed more than the stock, right? But it's not just one person out there shorting. There's a whole bunch of people. It's a big market. There's millions of people in there buying and selling. So if, for example, we'll say, for example, if you shorted GameStop, or if I owned GameStop, right? I lend it to you. So now I'm going to get that 30% a year interest rate on that. You then sell it. So you're short. Now, someone else, one of the viewers out there has bought it from you when you sold it short. They just get it in their brokerage account. They don't know that it's some special shorted stock. It's the same as any other stock they get in their brokerage account. And they see that they can earn 30% a year by lending it out and also get the return on the stock if it goes up, right? And so they then lend it out to someone else who shorts it. And so this doesn't happen very often because people are usually, there's just not that many people who want to short that much stock, like usually short interest is it's a bit of a niche.
It's a marginal business.
Yeah. And in particular, when it gets expensive like that, people don't really want to get involved most of the time.
I mean, I've seen it a lot with Nikola. Nikola had a massive interest rate because a lot of people thought that. But outside of Nikola, I haven't seen a lot of cases like GME where it was like so expensive because, I mean, the demand is insane. But hey, Patrick, why would the regulators not just say, hey guys, you can't short a stock that's over, if the market hits, it's public information, so we can see once the tally hits 100%, no more shorting until it goes down below 100.
The regulator doesn't have to tell you, like when you call up the stock borrow desk at your prime broker and they say it's 30% a year borrow cost. That's the world telling you not to borrow it, right? Because, if you think, I did a video ages ago, maybe a month or two ago, explaining short selling. And one of the things I put up was, the returns of short-only funds. Because one of the other kind of big piece of misinformation out there is people think there's these evil shorts who make all this money, right? They're making all this money, everyone's getting ripped off. If you look at, I think I put up like a 10-year return of an index of short-only hedge funds, and it's flat to down slightly. Like they're actually in aggregate not make. Now, some people make money off of it, but not in general. It's a break-even business, and it's a break-even business because, firstly, as we all know, stonks only go up. But secondly, you've got all these other costs thrown in at you, and so in truth, a lot of the reasons even that people will short something, they might be in more technical strategies, where we'll say, for example, someone has worked out that Exxon and Shell are highly correlated to each other. So when one goes up, the other goes down, they go together. And one day they see that one of them went up and the other didn't. So they sell the one that's gone up a bit and they buy the other and they just wait for them to come back. That's kind of how a lot of people short stocks. Another thing you'll see is it's just part of derivatives hedging, because whenever you buy an option, often there's a market, there's more people who want to buy options than want to sell options. And so there's market makers out there who will make a market and they'll essentially manufacture an option for you. And what that involves is basically that you buy an option. If you buy a call option from them, right, what is their risk? Their risk is that the price will go up a lot. So they then need to buy the underlying stock in order to hedge that option. And so equally, if you buy a put option from them, they have to hedge that as well. So an awful lot of the day-to-day sort of shorting that you see is kind of little technical things like that. And it's not necessarily, it's not like an evil plot to end the world. It's just sort of someone with a trading strategy that possibly makes good sense most of the time. This week, not so much.
Patrick, I want you to be a prophet now. By the way, for those of you who just joined, we have 2.4 thousand people in the chat right now. So for those of you who joined, this is Patrick Boyle. He's a hedge fund founder and manager. It's a quant futures hedge fund. It has nothing to do with what's going on right now. He's from the UK. He's also an academic. He's a professor at King's College in London and an author and one of the good guys here. So Patrick is here to teach us a lot of the nuances of the story, which we all always know get lost in the agendas that gets thrown around. So I think that's important to hear his explanation, because this is really fascinating since it's coming from somebody who's a professional in the business. So Patrick, I want you to be a prophet here. How does this shit end? This is my most financial way of asking this.
It's an interesting thing because, one thing that's kind of interesting is that a lot of the news over the week has been very much saying that retail investors are piling in and that institutional investors are on the, it's sort of put forth as this battle between the two. Interestingly enough, some of the market makers release data on this, and I think
Citadel.
Yes, and Citadel is the sort of a high frequency trader / market maker that is that you're buying and selling to if you're trading.
There's actually two separate entities, but it's different citadels. The trading.
Well, no, the hedge fund is different than the
market maker.
But it's essentially
okay.
And so it's all owned by Ken Griffin, though. So
we know that. We know that story.
So the thing is that the retail investors actually got in on Monday or before Monday. Like all of the flow was kind of earlier. And so what's happening now is not like the story is that the Robinhood investors or the Wall Street Bets boys are sort of destroying the market. And the truth is that they kind of had their position already. And, but they're showing right now that around half are buying, half are selling roughly at the moment. So those guys are actually more balanced. What will end up happening is, the truth is GameStop probably isn't worth what it's trading at right now. As much as we have to pitch the efficient markets hypothesis, it may not be worth what it's trading at right now. And it sort of becomes an issue where it's all about where you got in and where you got out. Like it's kind of like you can look at something like the NASDAQ in 99, 2000, and what will eventually happen is, someone will eventually start selling it near the top and make an awful lot of money. Like there's people who possibly got in very low and will get out very high. And other people won't. The other thing that will happen, there's a few interesting things, like with a lot of people trading options, like if their options expire deep in the money, that kind of works for them. But at the other side of those options, we've got these delta hedging market makers. And so they've had to hedge the option right up to expiration. And at expiration, they're stuck with a position in the stock that they then dump because they no longer are on the other side of an option. So you're going to really just see, like in the same way that it's sort of squeezed on the way up, it'll possibly squeeze on the way down. A good example to look at, because the biggest squeeze I've seen was the Volkswagen squeeze back in, I think it was in 2008 maybe. And there were some technical factors around that where Porsche took there was a big long short trade in Volkswagen relating to people trading the pref shares against the ordinary shares. And so there were a lot of people who just had this long short position on in two streams of Volkswagen equity. Porsche came in and just started buying one of the two streams, which drove the spread really wide. And of course, the problem is that people trade these spreads on huge leverage, right? And so they had to start unwinding. And so you saw this massive squeeze where at the time, I think for a few days, Volkswagen was worth more than the entire global auto industry, almost like Tesla. And it then returned to being worth what Volkswagen was worth.
So I'm hearing from you that listen, that's what, okay. So my opinion was that GameStop is definitely not a $3 or $4 or $5 stock. I think it's a solid $20 to $30 stock. In my personal opinion, it doesn't have a good future. I don't see how they can fit it in the modern gaming retail online business, which even Amazon is losing to the actual console manufacturers themselves. So it's just my fundamental analysis that they have no future. But I mean, a lot of smart people are saying, hey, there's a bull case to be made here. I mean, Ryan Cohen is not an idiot, obviously. I mean, he believes in the company. He went in. So you're a quant guy, and I totally understand that. But I mean, what's the realistic pricing of the stock once this whole thing blows over? Whether it's today or in a month?
I couldn't tell you because I actually have done no actual analysis on the stock. I'm just paying attention to the markets and what they're doing. But the most like the sort of simplest answer is it'll go back to roughly where it was trading, or like you said, it might go back to 2030. Like maybe there are people making a case that it's not as bad a situation as was being priced in. And what has happened over the last week is everyone has started looking at it. Maybe a stock gets cheap because no one looks at it and they just go,
yeah,
retail is dead, and video game retail is particularly dead. But now everyone has looked at it, and so it is reasonable to say that if it wasn't trading at a reasonable value, it should be trading at a reasonable value in a month's time.
But also think about this: the brand
and then the question
is
is just how people get out. Sorry, go ahead.
There's a delay, so I didn't hear you. Kept talking. Okay. I was saying, and actually, the brand, the name, the IP itself is now worth more because it went from being a kind of a household name in America to a global household brand. I mean, everybody knows GameStop. I mean, there's a value to be made here as well. I mean, now it's if you think about going retail online. I mean, there's certain like recognizability to this brand that probably didn't have before. So I want to ask you a quick question. Did you hear that Citron Research has announced that he's no longer going to be shorting stocks whatsoever? Did you see that video?
I did see. I heard it. I read it in the newspaper, but. Yeah, it's an interesting thing because he sort of built a brand, I guess, around short trades, and it's a bit of I imagine it's going to be difficult for the guy because there's a different clientele for buying your long only ideas versus, so he has to find probably a whole new bunch of customers to buy his research reports, if nothing else. But I think he probably just wants out of the press at this point.
He got bamboozled by these Wall Street Bets crowd. But I mean, listen, there's a lot of smart people there. I was on their subreddit a few times. there's a lot of smart people there. It's not
Mm.
like the mainstream media wants you to think. I mean, there's not a bunch of yahoos there just exchanging memes. There's a lot of good analysis there. Really sound analysis. I'm talking like professional.
Mm.
There's a question here from the audience. Since we have about 20 more minutes left, I want to kind of get your take on this. So Andy asks or says, we act like the only possible conclusion is we hold and Melvin is forced to buy to close. My worry is how creative can the government get to bend/exploit the current law to screw retailers and give Melvin a way to save their ass. So I'm going to rephrase the question for Patrick because Patrick is a professor and an author, so he can answer a question like this. So let me paraphrase the question, Patrick, if you may. So, Patrick, do you think the fact that Melvin and all these other hedge funds, they're holding a lot of pension money, and they know they're playing with money that politically speaking, the government can't let fail? I mean, because there's a lot of fireman pensions, policeman pensions. There's a lot of pensions there that
Yeah.
we can't let fail I mean, the U.S. I mean, you're not from the U.S., but I mean, so they know it, and it's almost kind of allowing them to play this very risky game because they're saying, well, it's pension money. They're not going to let us go under. They're going to bail us out again like they did in 2008, right? So is there a case to be made here that they're going to get bailed out again? Do you think that's possible?
No, I don't think so. Because, well, there's a few things I would say. One is that the SEC is not actually, the SEC's whole purpose is kind of to defend retail investors. Like that's sort of what they're there for. They're to make sure that there's a fair and orderly market. They also, one of the concerns the SEC will have, and what you're seeing a certain amount of hand wringing over, is they're worried that people won't view the markets as a safe place to invest in the long run. And so they want the market, like, because if companies no longer will go to, will no longer issue stock in order to finance themselves and grow their businesses, that isn't great for America, And so the SEC really, they're kind of the referee in here. On the topic of even the pension money in there, like there will be a certain amount. It's probably not all pension money, just to be clear, because
No, I'm just saying they hold a lot of it.
They'll hold some of it, but the truth is you get way more regulation if you're sort of an ERISA fund, like if you take more than, I think, 20% pension money. So they're probably less than 20% pension money. I don't really think the SEC care about hedge funds, What the real game here is kind of who can hold out, right? Because we basically got sort of, two sides shooting
It's a
at each
Mexican
other,
standoff
right?
at this point.
Yeah, it's really like the way Melvin or the way the short sellers could win is just if they have more staying power, if they can get more capital. And it is possible that a very big person can come in and say, look, we don't know when or how, but over the next, we'll say 12 months, this thing is going to fall from, I mean, it's no point even saying where it is right now because it will change in a second, but it's going to fall from this high level to a level closer to where it was a few weeks ago. And that's a huge gain. You do have to pay the 30% borrow cost, but the risk for people who are sort of trying to outgun these guys is just that someone with an awful lot of money and an awful lot of staying power can actually just outweigh you. Like they can put the money up and just sit there until it happens. That's possible. I don't really think, one of my first videos on this was about whether the SEC will get involved. And I think the only thing the SEC will get involved in is sort of laws being broken. And it's not obvious, you'd need a securities lawyer on here to really give you strong answers on this. But it's not obvious to me that what's happening on Wall Street bets isn't obviously market manipulation. Like there's a few things that are against the law. Some of them are ill-defined, but it seems to me that if it's a diverse group of people buying a stock because they think it'll go up in price, there's many reasons. Like you could build a DCF and say, I think it's going to go up in price because it's undervalued, or you could just say, there's a short seller that has to cover and I think it'll go up in price. Those are reasonable. Like if someone was telling lies, if someone was saying that, that GameStop had found all the missing bitcoins, then we've got a problem. We've got someone lying to manipulate the price. But if people are trading on publicly available information, there's nothing wrong going on. And I don't really, the SEC will be paying attention to make sure markets are stable, that a big hedge fund doesn't go bust in an unruly manner, kind of the way they had to with long-term capital management. But beyond that, there's not really, if laws aren't being broken, and they are really more on the side of retail investors. And even you've seen some of the political talk this week where you're seeing from sort of both sides of the bench, like, politicians don't ever want to be seen sticking up for a big short selling hedge fund. So even the political pressure is on the side, in my opinion, of small investors, as long as no law breaking can be observed.
You know what, Patrick? I found it funny that it's completely become a bipartisan matter. For the first time in about 10 years, all the politicians agree that there's one evil Darth Vader and they're all... we finally have
Wall
that
Street
evil...
Bets has brought the country together.
Wall Street Bets has brought the country to, for the first time in a decade.
This is the centrist political party that's needed,
But about 4 days ago, you would ask a Republican and a Democrat, is it raining outside? And they both give you a different answer from the same porch. Yeah. And now they're all sitting around the campfire, singing songs. And I love that. I love the fact that now we have like a common enemy, and it's beautiful. But are you surprised that we have not heard from the SEC? And they're just, which I expected to hear something from them. Hey guys, we're on it. Hey guys,
they will be paying attention, but they equally, I bet all of the big firms involved, like the hedge funds, will have heard from the SEC. I don't know how it works with Reddit as to how that works, but like lots of people will have heard from them. They'll be paying attention, but essentially they will be looking out for law breaking or for something that's causing market instability.
Do you think that for the, there's a question here from Nicholas Stanks, says the SEC have said they're investigating. So I haven't seen that, but if that's true, that's interesting. And Gabriel Ferrer asks, Tom, please ask Patrick if there will be any cybersecurity threats for Robinhood. I don't understand what this means.
Oh, I think he means like will like hackers or whatever have a go at Robinhood. I mean, I don't know anything about that.
That's probably not the. So I want to kind of. Somebody asks, Tom, is your given name Sergey? It's definitely not Tom, but it's not Sergey. Somebody asks, Tom Nash, please ask Patrick regarding short ladder to come before closing, followed by a push up as shorts buy back up. Did you understand?
I don't really know what that means.
Sorry, Stephen. Both of us did not understand the question. It might be just the chat. There's a lot of nuance that's not in the chat, so don't take it personally. So Patrick, I want to ask you a question. In your video, and by the way, I suggest you all watch Patrick's video. You talked about what the Nasdaq have said about monitoring the chatter online. You want to comment a little bit about the ridiculousness of that statement?
The thing is that these guys as well, you have to imagine if you're someone senior at the NASDAQ, you're getting tons of calls from reporters and things like that, and you're being asked what you're doing in order to make sure respectable things are going on in the market. And I don't really, I read the report and it didn't make much sense. Like they said that they're going to monitor social media and see if there's chatter that then relates to unusual activity in stocks. And it doesn't, I kind of think they're just sort of saying, we're the grown-ups in the room, we're paying attention to what's going on. But I doubt they've built out some massive, software package over the last 3 days that monitors social media and looks for market anomalies relating to it. I think that the real message from the CEO of the NASDAQ is kind of that we'll pay attention and look out for wrongdoing. And I think that's really all. These guys, it's also like the NASDAQ, it's the National Association of Securities, AQ. It's a big name, and
We don't care. We like the
really
stock.
they're a self-regulatory organization, and they're what they do is they regulate the market so that the government doesn't have to, if you know what I mean. Like it's an organization of broker dealers that self-regulates in order to avoid being more heavily regulated.
They're the
And
grown
so
up in the
they
room.
want to be seen to do a good job.
They want to be the responsible grown up in the room, pretty much. That's a job.
Yeah.
Yeah. Patrick, is that Will? Will, is that you? I think our guest from last night is asking a question. I don't know if somebody opened the profile with his name or it's actually him. Last night we had the guest. By the way, we have 8 more minutes left on the show, so let's make a good use of it. I could have you on for another 3 hours, and we'll probably do part 2 if you have time in another day. So and the response from the audience is amazing. People are really liking you. So Will, I hope it's you, Will. And Will, by the way, is holding 1.14 million US dollars in unrecognized gains from GameStop. He started buying at $3 and he's not selling. He's one of those crazy subredditors who basically sticking it to the
sell. Just don't tell anyone.
Everybody's been saying this. He's not going to take it
slowly.
Everyone is telling him to sell. He's like, it's not gonna help. So he's asking, Patrick, do you think this changes the psychology of the market? He says, still holding, by the way, rocket ship.
It does. Like, it does change the psychology of the market in that, I kind of argue, I used to work for a famous fund manager named Victor Niederhofer, and he had this theory. He borrowed it from a gambling book called the theory of ever-changing cycles, and essentially the idea is, and I think it holds very well in markets, that whenever something works for too long, it has to stop working just because people come in and they start arbing away your advantage, right? And so for a long time, certain short sellers have kind of had this game where you kind of quietly put on a short position and then you make a big announcement and the SEC, by the way, are all over these guys because it's not a respected approach, but they release sort of a research report saying that it's a piece of junk, and that knocks it down enough for them to get out of their trade. And this has been going on for, I don't know, probably for quite a while. But I think now these guys, like even when you see the Citroen story, I think these guys kind of probably have the feeling that you no longer will get away with that. Because if you announce that you have a huge short position, and here's my research report, there's a real chance that you've just painted a big target on your back. And that's a new thing. And markets adjust, markets change constantly. And so whatever worked in the past, it works for a while, and then you need to come up with something new because you can't win the same way every time. It's like a sports game. Like if there's a guy who always kicks the ball into a goal a certain way, after a while, everyone is waiting there for him to try that. So
it's a great answer. Potatoes are life with the Y. It says, if there's any class action lawsuits, how will it indirectly affect people who are implicated? I lost 60,000 from ATH because of Robinhood banning trading. I think what he means is that the question is basically when they got exposed. I mean, Robinhood, Webull, all these platforms who are like geared towards retail investors, at some point their liquidity shortcomings got exposed. One short squeeze and they were you suddenly see it's a moped and not a race bike, right? So a lot of people potentially can claim they lost a lot of money, but Patrick isn't a lawyer, so I don't know if the question is right for Patrick. So I'll answer it because, but you can take a stab at it if you want.
I would just be giving an uneducated opinion.
The only thing I can tell you is this: I have this T-shirt and I did study law, but I mean, this is not legal advice. So here's my layman opinion: ask a lawyer. But I think there will be class action lawsuits. I think there's a lot of opportunistic class action lawyers in the United States who are loving this right now. They're going like when this thing happened,
they will win. They're the real winners.
Yeah, the class action lawyers are buying yachts and houses at this point and Ferraris, maybe Teslas at this point. So that's what I think about it. Hey, by the way, there's a reference to your video here. Bob I can spell your last name, Bob. Bob says he's a channel member. Patrick has a great video on Ponzi schemes on his YouTube channel. Yes, he does.
Oh,
Phenomenal video. Go check it out. Bovayev just joined as a channel member. Thank you. Welcome. Patrick, we have 3 more minutes. I just wanted to make sure we don't have any super chats left, so we don't, skip any of the people who actually contributed. John J. Jonathan says, "Hi, Patrick and Tom. Patrick, can you please explain any deceptive tactics fake gurus in the financial world do and say that does not get talked about enough?" It's a tough question for 3 minutes.
I don't actually know an awful lot about what these guys do. Like CoffeeZilla is sort of the expert on that. One thing I would point out is, and I won't name any names, but someone kind of commented in my channel about a week ago saying that one of these guys actually is a great trader because they've seen his live trades. And someone else pointed out that his live trades are on a 15-minute delay. And I would warn people that if you're mimicking someone's trade on a 15-minute delay, odds are he's out by the time you're piling in. So I think that's one thing where people say, I see this guy winning and winning. I would be concerned if there's a 15-minute delay. I know why you see him winning, because he picks a penny stock that doesn't trade much. He buys a little bit.
Creates
then
volume.
All of his audience pile in 15 minutes later while he gets out. And that's
A classic
probably
pump and
one
dump.
thing I would watch out.
A classic pump and
Yeah.
up, low volume stock with the,
Yeah.
with the low price. Yeah, that shit has been as old as a vodka.
Yeah.
Guys, don't super chat anymore because Patrick literally has 2 more minutes. We won't be able to read your questions, so don't super chat. There's one more super chat from Anonymous. Robinhood isn't letting me buy $5 of Starbucks. Limit is 1 share. Anyone experiencing this? Okay, so I think what he's asking here, and I know the answer. Tell me if I'm correct, Patrick. But he's basically asking about the limits they put on stocks is because they got exposed. They don't have the cash to clear, to put the collateral.
I think it's just a risk
They can't set up the
exposure.
collateral,
that
not
they
even the 3% now, because they have to count 48 hours for the 100% collateral until it runs out for all the massive action that went on the GameStop stock. Yeah.
I said in my video yesterday that when I explain the problems with Robinhood, that's why they won't sponsor my channel. So it's
go. Let's plug Patrick Ball Finance. Look it up. It's a great. 1 minute, Patrick. Last question. So if you donate after this point, hey, I'm not responsible. Rory, your last names are worse than mine. Asks, why? Sorry about Rudy. He asked, why isn't there cash padding requirements at hedge funds to prevent rebalancing because of a short squeeze of any form of market instability? I'm going to read it again. I think I know what he means. Why isn't there cash padding requirements at hedge funds to prevent rebalancing because of a short squeeze of any form? I think what he means is basically like a bank. I mean, banks have to hold a certain percentage in collateral. I mean, why is hedge funds are not required to cover their shorts? They can just.
It actually is the same at a hedge fund. So you if you want to short a stock, it's a margin account, and you put up margin. You borrow the stock, you sell it short. And then as you start losing money, they start demanding more margin from you. They don't let you lose 100% because then the broker might be,
and it also depends which fund. I mean, if they know that Melvin has a relationship with Ken and Stephen Coyne, they know they're good for it, so they're going to have.
They're
margins.
not good for it because those guys won't. Those guys aren't suckers. They don't write checks after.
They just gave him a check for $3 billion.
Yeah. No, before, right? But if it went bust, they couldn't come knocking on these guys' doors. These guys would say, "I'm sorry, I've never heard of it."
Oh, I mean, yeah. You mean their liability issue? Yeah, the ones. Who
like the brokers will be asking them for more capital, and they will be scrambling to come up with capital one way or another. And if they can't, they're scaling back their positions, and the brokers just will not let them do anything else because these big firms, they're your best friend when things are going well, and as the song goes, nobody loves you when you're down and out. That's how it goes.
Can you imagine the phone call right now? Gabe Plotkin is calling Ken Griffin. Ken is like, I'm in a tunnel. I can hear you. This is literally what's going on right now. It's like, not real, not literal. This is just satire.
Yeah, we have no information.
This is just. I'm kidding. Hey, Patrick, we're already 1 minute after, and I know that you have a hard stop here. So we can't continue anymore since you have a hard stop. It's quarter to 9 at your time. So at this point, we have to stop. So everybody, thank you for coming in. Thank you for Patrick for contributing his time. If you guys want a part 2 with Patrick, which I think you do, because Patrick just really, we can do this for another 3 hours. Like the video. If this hits like let's say 3,000 likes, I'll do a second part with Patrick. If not, then I know you guys are not interested. So simple as that. Patrick, thank you so much. Go check out Patrick Ball Finance on YouTube. One of the best channels in this category. Criminally undersubscribed, as my friend Steven Coffeezilla coined that phrase. Go subscribe to Patrick. Patrick, thank you so much. Appreciate it. Hope we can do part 2. Let's see if they can.
Thank you. Yeah, it was
the
fun
likes.
talking.
Let's see if they can